Hi, this is Randy Finney with Right Side of the Chart, and this is a midday market update for Wednesday, October 17th, 2018. We haven't had really any technical developments today that since my last update yesterday. However, there are some things I didn't cover in those last charts that I want to, in that last video, I should say, that I wanted to cover here. Some of those were prompted by members in the trading room, so really good questions brought up, and I want to show you some levels and things again that I didn't hit on before. Well, some that I did and some that I didn't. Let's do it that way. The first one had somebody brought up in the trading room and right side of the chart.com. They asked about the 20, or they stated that S&P 500 or SPX broke through heavy resistance at 2,800 yesterday and is consolidating between resistance now, which is support, and brought up some good points there and mentioned some moving averages. So they mentioned that level is 2,800. I had this level on my chart for a while. I usually don't in the videos. You don't see me use S&P 500 charts often because you can't trade the S&P 500. You can't buy it at 2,800. You can trade futures, but they're not even tracking. There's always a discount or premium to the cash value. So this is a cash S&P 500. You can't trade it directly, just like the VIX. You can't buy or sell the VIX, only derivatives of it, options, futures, etc. Anyways, if that confuses you, just remember that why the reason I do this is, I focus my analysis on SPY because you can buy and sell SPY. That's what people are selling. So therefore, I might as well point out those levels. But now the S&P 500 is very important. A lot of technicians watch it. It's worth mentioning. So there it is, 28. I had it at 2801.76, give or take. Again, there's large swings, but you can see it's a very well-defined level. So that I agree with. The person in the trading room that mentioned that. And yesterday and in recent videos and even in recent weeks, I've had this level here, 279.26. It's a comparable level on SPY. So that equals 2,800. Remember, SPY is an ETF, pays out dividends and things. It's not always going to track it, the one tenth of the price. So, where are we at? Where am I going with this? So we're at resistance, a hair above it. So you can say, and I always say this: resistance once broken becomes support. However, I've also said recently when volatility surges like it has, these big candlesticks, you have momentum fueled overshoots, you have big price swings. So it's not only normal, it's almost to be expected that certain resistance and support levels will be overshot, especially intraday with all this intraday volatility lately. So on face value, yes, you give this check mark to the bulls. They took out 279.26 as long as they can defend it now. SPY is in a more of a bullish than a bearish technical posture. Okay, so we'll go with that. Now on the S&P 500, go back to that. I have two trend lines here. This white trend line I've had for a while, and it captures this. I think is a better fit of the two. Let me show you what I'm talking about when I say the two. I have another one below that I updated recently, and I talk about this a lot. I'll do what I call a BOD or benefit of the doubt trend line. If I can draw two trend lines and they're both valid because all right, they come off the same points. They had a lot of reactions back here where it generates one from below, and then you can see it starts picking up. The white trend line touch comes in and captures these reactions. The yellow one does not, but the yellow one captures these spikes. Now, when I draw a trend line, and I always say this, trend line drawing is an art, not a science. Everyone's going to do it different. There's really no right or wrong. I just tell you the way I do it. I try to capture the maximum amount of candlestick bodies and or shadows. So the fat parts or the skinny parts. And in volatile times, sometimes you slice through support. So yes, the white trend line is violated quite a bit during these volatile periods we had earlier in the year when we had those big sell-offs. But so that's why I have the alternative trend line. So you want to be safe. You see 2742 and that yellow trend line go on the S&P 500. And again, you could replicate a similar trend line on SPY. But I wanted to point out that the white trend line also, I believe it's valid, may come into play, may or may not, but you can see there's quite a few reactions if you exclude all this volatile trading. And even there, you had a candlestick body on there and a couple candles there. So again, just a pretty well-defined trend line. And the point I wanted to make, because I did not point this out yesterday, we're back testing that trend line as well as roughly that 2,800 S&P 500 level. And there's the breakdown of the wedge we had here. This is what triggered the sell-off, and something else I'll get to here in a second that I didn't cover yesterday. And that was from another question in the trading room about Well, the question was about financials, and I segued it into tech. So go figure. I'll tell you how I got there. So there it is. That was a very important level. What this level was on the S&P 500 as well. You had an all-time high right here. Oh, I didn't do that right. That should have been a circle tool. You had an all-time high. You came up, tested again, failed. Finally, a breakout to all-time highs. Hooray, hooray, hooray. And that's a technical breakout, not just a punch to new highs, because there was resistance. There were several failed attempts there. It was successfully back tested. Again, all this was covered at the time in videos. Then, when the breakout failed, number one, a couple things happened. You had the rising wedge, negative divergence, everything, the case that was laid out before it happened, while it was happening, and what was also laid out at the time, and I haven't talked about this since that much, that if we failed that level, that breakout there, this circle here, we failed a breakout to new highs. So that is a failed breakout, which is AKA a bull trap. Gets longs piling in, and that's bearish technical event. So, and it could have, because it happened on such a large time frame on here, it could have longer term bearish implications. So, um, if not, we certainly, like I said yesterday, got to give a check mark to the bulls yesterday. Although there's, a bit of you can't validate 100% that big move because of the volatility. There was undoubtedly a lot of short covering, and we'll just see where we go from here. I'll just tell you right now, my convictions aren't super high this week, but I did mention some levels that I think you could short at yesterday at the close where we ran into, and still today we've had another opportunity. Um, Maybe the SPY wants to come up, but it still has a lot of resistance overhead, and that's again on the S&P 500. All right, let's go to SPY. There's that level, 279.26. And as you can see here, you can play around with this trend line. That's a longer term trend line, by the way. That trend line comes in from the early 2016 highs. So this is something, and I don't believe I mentioned it yesterday. Depends how I want to drag it here, but roughly we are back testing that level now. It came in and captured a lot of these lows back here. So there's a back test from a broken trend line on the daily chart. I know I'm giving a lot of contradicting analysis. I'm showing you long-term trend lines and key moving averages recently that were held and have held support. My job is to show you what I see out there, tell you what I think, but I'm not going to sit here and make a one-sided bullish or bearish case unless a very strong one can be made. So I'm showing you there are some mixed signals, and that's what the market's doing. The market must agree with me because it didn't melt down. It held those supports, and I think there's a lot of traders out here. Most people see what they want to see. Bears are seeing what they want to see. Bulls are seeing what they want to see, and this will be resolved sooner or later. But I wanted to point this out that I'm still leaning towards that other thrust down scenario, despite yesterday's or the day before the big rally. And I said that yesterday, and that's where we're at now. So we're at some pretty decent resistance levels that I didn't cover in yesterday's video, and then there's some other things I want to show you here. Okay, and this is it. And I don't know, this is how my mind works. One thing leads to another. Strings. So the question was put to me in the trading room, Randy, or right side of the chart. How much credence do you give to the old adage, the rally can't continue without the participation of the financials? And talked about today XLF challenging some resistance levels. Well, my reply was this. Number one is, in the wake of all the quantitative easing and all the liquidity injected in the market, this stock market's been lifted higher. And what I've noticed over the years is a lot of the old adages, old things, Dow theory, financials have to climb, haven't worked as much because I've seen corrections, several corrections in financials and other key sectors, yet the market just continued to chug on up. And that was because we've had a tremendous amount of sector rotation. So, although the broad market, you look at a chart, it looks boring, steady grind over the last few years, there have been opportunities within sectors. Sectors correct, others pick up the slack, but none more so than technology. One thing that's been pretty consistent is the uptrend in tech. And if you recall, if you followed me leading up to this drop and before, I must have said it over 24 times. When tech breaks, the market breaks. And so tech has helped lift everything. So I'm not so concerned about the financials. And they don't make up for what they used to as far as the percentage. This is a little dated. Remember, we had that rebalancing I mentioned in late September, so just a few weeks back, they rebalanced the S&P 500 for the first time, the biggest rebalancing in a while. It's just over 20%, so but it's still the largest weighting, so 1/5 1/5 of the performance of the S&P 500 comes from just one sector, and that's technology. So as I said before, when tech breaks, the market breaks. So far that held true. Tech broke. This is the level I was watching. This white trend line was the more significant of the two. This is much better defined. This was the one I was highlighting for a while on XLK. This is a bearish rising wedge pattern confirmed with negative divergence, just like we had divergent high here when we had the two biggest corrections in years in tech. They were both preceded by divergent highs, as was this one. So when you want to know when the market broke, it broke the day tech broke on October 4th. Quick sell-off. So now, okay, what was the point? Well, number one, we hit this target right here. Can see we had very good support at 60, right around $68, give or take. And you can see, again, I'll point out if you don't see why, a lot of reactions there. It was resistance, resistance, then we broke it, back tested, held it successfully. And so far, we've held it again successfully. But that's a level to watch. And obviously, bearish if that breaks. Tech has, after the bounce we've had now and where the markets are, there's really zero margin of error because as every week goes on, remember I was highlighting those weekly trend lines. Uptrend lines have a positive slope. That means as time goes on, if you keep pulling back to the same level, you're going to be below it. So the next we go here this week, next week, there's not much of a difference in a weekly trend line where it comes in week to week. But I just wanted to point that out that we already pierced the indexes and QQQ and everything pierced a lot of big supports intra-week last week. So we have very little margin of error or room for error. And then here it is. We have this trend line. And I'm going to show it to you on another board here in a second. Very well defined. It captures, comes in from that initial correction and back in the lows back in early February. A lot of reactions. It's not super well defined here because we only have a few reactions. If we get another one here, and that's what I'm looking for, that would help to validate that trend line because we haven't had a reaction since back here in, what was that, May or so, late April. So look for that. So basically you're looking at a back test here. And let me show it to you on another board here. There's that same trend line. I've had this one on here for a while. I started this trend line back in 2017 and it goes back a way. So that's, I'm guessing off the, the early or the mid. Remember, XLK, tech stocks, and QQQ had a mini crash in mid-15. Most of the indexes will pick up this same trend line. The S&P 500, the NASDAQ 100 or NDX, all pick it up here in the beginning of 2016. That is a well-defined trend line. It has numerous reactions, including it caught all the reactions, contained all the pullbacks here in that recent correction. We broke that trend line last week and we are back testing it now. So keep that in mind. And again, I know I'm showing you a mixed bag of technicals, and but so far rejection. You can see it. We hit it yesterday. We stopped cold on it. We opened today. Those same levels I mentioned yesterday in the video. We could have, and it was an objective short at the close. Still, we got another opportunity today, and so there it is. Now, if XLK can regain this trend line, that's bullish, especially on a daily close, even better on a weekly close. Then the next resistance, I could add some levels here. I can tell you we do have some horizontal resistance here around 72. But then we come in and maybe back test this wedge. So right now, and again, based on the scope of these divergences that we had in place and what I consider still a relatively minor correction, I'm still leaning towards this being just the first wave down and a correction with more downside to come. And we'll watch here. So we're at a pretty important battleground. Again, I showed you S&P 500, SPY, QQQ. Maybe I didn't pull the Qs, did I? Okay, QQQ. I can play around. There's a lot of variations on the trend line, but this one, at least on the daily, has been taken back. The weekly trend line held. I showed you on the weekly charts. Again, if you're new to the analysis, there it is. That's that off the 2015 lows so far on a weekly closing basis, and so far this week it's held. So we're still above key long-term support right now, and you cannot write this market off until those levels go. But on the daily chart, forget about this trend line the way I have it drawn here. Let's look at these horizontal levels. 170, about 175, and that was taken out yesterday, 174 to 175. That was that bullish green candle. But again, I mentioned 178 is a pretty significant level too, and we ran into that now. So as I said before, the price action on Tuesday was pretty bearish. Yesterday, undoubtedly, bullish, undoubtedly, with a big green candle, but it was also part of the norm recently with this extreme volatility, probably a lot of short covering. And more importantly, I said that personally for me, I don't go long there. I'm still holding on to that, leaning towards the short side because there is a lot of overhead resistance here, a lot of overhead supply, and there it is. So QQQ had this trading range for most of the year here, or sorry, the most of the second part of the year, third quarter, and we're now coming and back testing that from below. So there's a lot of work to be done. It doesn't mean the Qs can't continue to push higher, but that's that. So if you're bullish and you bought in yesterday or any point where after, like I said, continue to trail stops up, you're going to have to successfully swing trade this market until volatility abates. You'll have to use wide stops or they're going to run them. That's what the market makers are doing, and not just the market makers. It's people. There's huge mutual funds, pension funds. Pension funds. That's my other thought right now. Volatility has been so low for so long, and what happened this time around too. Now I'm digressing a little bit, but I've talked about to members of the site. We're watching TLT as a potential trade idea, and usually you get a flight to safety in treasuries. Well, what precipitated or added to this sell-off recently was treasuries continuing to climb. Usually when there's a stock market correction, there's a flight to safety. They buy treasury bonds, which cause the prices to go down. I said that wrong. What it usually does is cause a flight into treasuries, which cause prices to go up, yields to go down, is what I meant to say. And we saw the opposite. We saw yields tick up recently. What does that mean? Well, these huge pension funds, even hedge funds, mutual funds, they have to balance risk. So they took it on the chin in the stock market a couple weeks ago. And then normally when their bond portfolio, because they use asset allocation, they're diversified, uh, would help buffer the gains. They didn't see that recently, so I don't know. I think we may see, and I still believe it. Whether we bounce for a few weeks here or not, whether the bounce is over, I still think there's a pretty big correction coming in Q4, and part of that will probably be the unwinding of risk exposure by those large institutions that they're where do they hide if there's a big market crash and you're not seeing treasuries go up. um, there's other things out there as well, but for the most part, you saw what happens in a broad-based sell-off. Just about all stocks and all sectors fall for the most part, and that's what we had recently. So there it is, and we'll wrap it up here with the NQ 60-minute chart or 15-minute chart that I've been highlighting recently. There's that symmetrical or ascending triangle pattern. That was the breakout yesterday, and our big rip following that breakout. And we came right up here to, you can see there's a resistance level right there around 73.36, little divergent high if you look there. And so far we're below that. So bulls want to see that level get taken out, especially those highs and NQ right there. And the bears want to see the breakout fail. And these are the levels I'm watching. So the top of that range, the breakout, this was really the level I was looking at here. And as I mentioned in yesterday's video, you have this uptrend line as well. They come in roughly together, but being that the horizontal price level is a little below, that's what you want to see to really open the door for maybe another wave down that would wipe out yesterday's rally. And again, we started the rally a little below down here. I think we were, if I remember correctly. So yeah, you want to see not a move just slightly down below, but a pretty impulsive move down below. And then I think that could open the door for another wave down. And bulls want to see this level hold and then continue to move higher. And right now, that's about all I can give you. I gave you my thoughts on what may happen here and the reasoning why. And we'll go from there. This has been Randy Finney with Right Side of the Chart. I hope you enjoyed it.